Hello everyone and welcome to XM Live, to an absolutely new format here at XM Live where I'm very excited to introduce this. And this is Traders Talk. Now for those who are watching us on social media, XM Live is a service of XM where we stream every day on 3 different channels for 8 hours. So you get 24 hours of expertise every single day, live trading and everything for free. Now, I am extremely excited to welcome somebody who is world famous, I would say, in the trading world. And I'm very excited to introduce Ashraf Laidi today, who is, I would say, the expert on intermarket analysis. And I'm especially excited about this because we are 12 experts in our room and there is no intermarket analysis. So I'm really eager to understand what is intermarket analysis, how does it help us in trading, and also, for example, also today we have a very special day, Fed meeting. How can we implement intermarket analysis for getting an advantage in the market, an edge in the market? And so welcome, Ashraf.
Thank you very much, Gil, or is it Jill? Jill.
Yeah.
Jill, thank you very much for having me, and thanks for the XM team to have me in this new format and to start this new format with me. Where do we begin? I will try to make it very, very simple. Let's say most of the people who are trading, they know that, for instance, let's say when bond yields go up, gold usually go down.
Mm-hmm.
Or we can even use a simpler example, which is, and I have to be careful with this example, but when the dollar goes up, gold usually go down. Usually, not all the time, okay? So this is the purest, most simple form of intermarket analysis. When something goes up, usually other things go up or down, okay? So you can do it between bond yields and the NASDAQ. So for instance, when bond yields, this thing that the retail trader never heard of for the last 3-5 years ago, but now everybody is talking about bond yield. When bond yields go up sharply in a day, the NASDAQ falls the most, the Dow falls the least, and the S&P falls in the middle. This is an intermarket analysis. And another example, when bond yields really go down, the yen is the first one to win. And there is a whole chapter about this in my book, which was written in 2007, 16 years ago. I'm not going to get into the reason why yet, but we're not going to get into the why. We're going into the what. So this relationship, for instance, when bond yields go down, the yen usually pushes up. I'll give you the reason, because the yen is like the anti-interest rate currency. It's the currency with the lowest interest rates. Yields are by default interest rates. So when interest rates go up, the yen weakens. Okay? So when it weakens, when yields go up, the dollar yen goes up, euro yen goes up, the yen goes down. That means the yen pairs go up, okay? And let's say, for instance, when there was the Hamas attack in Israel, and it was a long weekend in the U.S., and the U.S. Treasury bonds did not open until a day later, because U.S. Treasury bonds are a safe haven, when they opened on Tuesday, the yield gapped down. And the yield gapped down and everything fell against the yen. That's an example. But then you may ask me, but why do we use it for trading, or how can we use it for trading?
And I'm sure also that there are changes in correlation. So what you're looking at are correlations and also probably changes in correlations, which I think later on in this talk, we will talk about this, because I believe we are in a very interesting crossroad where we could see changes. Like we had 1.5 years of raising interest rates all over the world, and they may now top. And so we get into different kind of markets. And I'm very eager to hear from you if you already see that in your intermarket analysis, but maybe this we will keep this discussion to the end of this hour. What I would like to hear, because you are, I think it's legendary John Murphy and you who are written books about intermarket analysis and are the experts in the world. How do you become an expert like this? I would like first maybe even to, by the way, I have to tell the viewers, I know you for more than 10 years and I started full-time trading in 2012, but I remember earlier, before 2012, I watched a show that you were at a reality TV show where you attended, and this was really funny. I liked this a lot, and it was kind of a big brother for traders. Like there were 10 traders, and you educated them, and each week somebody dropped out, and you were already then the expert who teach the traders. So it is really an honor for me now to be with you here, because this really strongly influenced actually my trading also then.
Yeah, well, that's great. Yeah, Jill, I appreciate, the kind words. And that was done in 2013 with a broker that I was working for. And the series were so good. They started with basically 10 traders and they were trading demo. And it was two experts, me and James Chen, who is a well-known technical analyst. Every week we would assess what they did for their trading, and before every week we would tell them what's going on, and then we would have to eliminate. Every week we would have to eliminate one trader until the grand winner won £100,000. He was a cab driver. He was a black cab driver, not an Uber driver, a black cab driver who was an aspiring trader, and he won it. So there were the last two. And it was around the lockdown, and he made a big trade in S&P and so on and so forth. And he actually won real money, £100,000. We had a big ceremony at the building of the London mayor, and it was very good because we would ask them questions and we would fire, the bad ones who did bad mistakes. But he actually won £100,000, and the account was put real money in his account, trading with that company, and he was able to take the money out anytime he wanted. So it was real money, and it was a great thing. It was done in 2013. Thank you. I am nowhere near the stature of John Murphy, who actually I remember meeting him for the first time. When I met him, I'll tell you when I met him. I met him in New York, in the World Trade Center, when it used to be the World Trade Center building. There was a big mall and there was a big bookshop called Borders, and he was signing books. He was signing technical analysis in the futures market, I believe it was called. And it was back in 2000. It was back in 1999, and he was signing the books. So everybody knows about that book, but nobody knows about the other book that he wrote in 1991, which is called Intermarket Analysis. And I was reading it in a plane going from Orlando back to New York, and I was reading that book, and I said, okay, this is a good book. It was written in 1991. It's saying that when the dollar goes up, the commodity prices go down, and when bond yields go up, stocks do this. And I said, this is good. And I was approached many times by, Wiley, by many book companies to write a book about the principles of foreign exchange. And the Cornelius Luca wrote a book called he wrote a book about the foreign exchange markets. And I wanted to write a book, but I was approached so many times to write the basics of foreign exchange. And I was very bored to write something like that. And it wasn't until 2007. So when I started writing it, and it was 2006, I believe, I was looking at the Murphy book, and I said, you know what? I could actually apply something to this, to the currency market. And I added something to it. Basically, I looked at the importance of the book was looking at yield curves, looking at the importance of valuing gold, not only versus the dollar, but versus other currencies. If you want to categorize which currency is the strongest today, in the last 24 hours, you wake up in the morning, wherever you are, and then you will see what is the strongest currency. There is a way to look at it, or you can value them against gold or against something that is not a currency. So things like that, and I added risk appetite. I added the gold to oil ratio. I added the yield curves, and I added something which was, I think it was the first book to ever write about this, which was risk on, risk off. When stocks go up, this was written in 2007. When stocks go up, why does the yen goes down and most of the other currencies go up against the dollar? But so the dollar goes down, the yen goes down, and the currencies go up when and the other currencies go up when stocks go up. But when stocks go down, usually the dollar goes up against everything, the yen goes up against everything. But what happens with the dollar versus the yen? That depends on what is the very, very driver that is driving stocks down.
So this is, I think because we are in this very unique place, a time now, we will talk a lot about this. Now, what I understand is you have to have a lot of knowledge, not only about currencies, but about many other things, like bonds. You're talking about bonds, and you talk about gold, and you talk about oil.
Yeah.
So where did you start? I mean, you probably, how did you become an expert in what you are? Where did you start? What was your start? What did you start here, and where did you start to work in order to get this knowledge? In order to combine everything together. This is what you did in the end, right?
Yeah. I would like to, thanks for this question. I would like to give a warning to the listeners. I do not want the listeners to be turned off or turned away or discouraged by me giving a sentence about gold and making a sentence about bond and giving a sentence about stocks and putting them all in the same sentence as if I'm trying to complicate things or as if I'm trying to show that I'm clever or that I know. I don't want people to get this idea. My job is to take all of that and to try to streamline it. And if you do it that often, then you can understand it. And so if you do it often, if it's part of your day routine, of your morning routine, you look at a gold chart, you look at this, you look at that, and then just like everybody, you, me, everybody, we are in a cafe, we are with friends, and we do this, and we do this, and we check the quotes, and we check the rates. But there is many ways, Jill, of checking the rates. What do you do? There's many ways. One way, and I'm going to answer your question, how did I get into this? But it's very important for me to do that, is that, so you look at the rate, and then what do? You're just looking, but what are you looking, right? So I tell people, when you look at your phone, you try to remember the last time you looked at the price and what it was. And when you look at it, you try to guess. And then when you look at it, you compare it to the session low, the session high. But I do all of this and more. And what I try to do, who is leading? Yes, the S&P is down, the Dow is down, the Nasdaq is down. But why is the Dow down 2.5% and the S&P is down only 0.5%? I try to make that mental exercise, and it's a tiresome exercise. But if you do it every day with a habit, you get it. So basically, listen, when I was doing my MBA in George Washington University in Washington, D.C., and the last class of my MBA, and again, you don't have to have an MBA to be doing what we are doing today. You do not. Yeah. So I guess in my bachelor's, I did something on currencies, on foreign exchange. But it wasn't until the last class of the MBA was a class called Central Banks and the Global Economy. And basically the teacher made us write papers, do predictions about how to predict foreign exchange values. My friend, this was in 1994. There was hardly an internet. I had to go to the public library, use the LexisNexis, use the periodicals, use the Wall Street Journal, and try to get what did the Deutschmark do, what the dollar did, what the yen, and try to predict based on a theory called interest rate parity. I will stop here with the jargon. Anyway, when I graduated, I knew that I wanted to get into some sort of something related to foreign exchange. We did papers on central bank independence, central bank intervention. Why? I mean, can you believe this? Your teacher tells you to write a paper about central bank intervention and does it work and so on and independence. When I graduated, I got a job in as a fixed income analyst for Reuters. I was looking fixed income, but I was not in the market. So I worked there for a year and then I quit. Even though I didn't have a visa, I had a temporary work visa, a student visa. I chose to quit. And I went down to New York. This job was in Connecticut. So I went to New York and I started looking for companies. I started knocking on banks. It was like big banks like Bankers Trust and JP Morgan. And this was in 1995, 96. And anyway, slowly, I found a company that started. It was about to go into online FX trading. And so I found a company. It was called MG Financial Group. And they were getting into foreign exchange. It was starting online. And it was the second company that was available at trading online FX. The first one was CMC. So I joined later CMC in 2006. But what I did, but I knew about interest rate parity. I knew about interest rate differentials. But I knew nothing about technical analysis. Nothing. And it was technical analysis when I started learning on that job. There was this guy from Hong Kong, and he used to bring his 5-year-old son, to the office and show him Aspen graphics, and slowly we start to read. And I was very fortunate. I was living in New York, and I was, there is this street called Trinity Street, which is in Trinity Church, which is close to the New York Stock Exchange, and it specializes in financial markets bookshop. I learned a lot. But slowly, my job there, it was to write. It was an analyst. My job was to sound clever after the fact. My job was to go on TV, was to be the chief global strategist for MG Financial Group. I was going on CNBC. I was going for CMC, which is a global company. I was going in Paris, London, New York. I was going to Singapore. I was going to Oslo. I went to Caracas in 2008. We were talking about the markets, teaching and writing reports. But I was doing some trading on the side, but it was very low level, trading based on fundamental. And based on fundamental is not a bad thing.
Yeah, absolutely.
But but then I realized that, but when I went totally on my own, like in 2000 when I left State Index in 2000 and when I totally left in 2011, 2015, I would say, that's when I really started to trade more and more. And then you realize then you have to use technical analysis. I use classical technical analysis. I combine candlestick analysis. I use RSI. I use the main moving average, but it's mainly the patterns, the key patterns. People ask which is your top book. Of course, you have to start with John Murphy, but there is Edwards and McGee book on classical technical analysis. Very non-sexy looking book. It was very old book written in the 1960s. Yeah. And you look at it and it's black and white and, it's old print, but it's the book. But then there were some very, very good books written afterwards. But then you have to apply this to trading. And here is the answer to your question. Why do I use intermarket analysis? I use something now called intermarket technical analysis. So if I'm looking at the euro-dollar chart, and it's about, right now, euro-dollar chart looks like a daily chart and inverted head and shoulder. A daily chart looks like an inverted head and shoulder. It tried to break the neckline. It broke the neckline. It came back. I'm telling you this without seeing the chart.
It still could be a correction, but it could be also turnaround, right?
Exactly. So 105.50, was a key support. But even if it goes 104, but okay. So you're looking at this and you're saying, well, euro-dollar, is it at a key support? Is it at a key support? So what do? You're not sure. So you look at something else that work, either is inverse to the euro-dollar or is directly related to the dollar, and you look at its own chart to get. So intermarket analysis is a form of cheating. You're trying to see something, you cannot really read it. So you look at the other thing that is kind of related to it, and is it giving you an interesting thing? You can do this with the DXY, with the euro-dollar, with the dollar-yen. This is an example. Here is another example. This is very important, and this is something new. We never stop learning. We never stop learning. I started to do this in the last 9 months, actually in the last year. I look at gold. So in November of last year, Jill, when gold reached the low at 1610, or 1612. When it was reaching the low, I was looking at intermarket analysis. I was looking at gold related to. I was looking at also silver, copper, and platinum. And guess what? Silver and copper and platinum, the three of them, they reached a low a few weeks and months before the low of November 2022 in gold.
Wow.
So this is what you call intermetals analysis. And yes, it's a sexy name, it's a new name, but it works. I'll tell you why. Because when I was in Dubai in October 20th, 2022, anybody knows what happened in October the 21st, that one was the biggest intervention of the Bank of Japan of all time. October 21st last year. Mm-hmm. But I was in Dubai in an expo and gold was tanking, falling. It fell from 1680, 1670, 1660, 1650. And here I am at a booth with the screen and everybody in Dubai coming in. And you know, in Dubai, I mean, they're huge gold traders. Everybody is an expert. Everybody is better than the other. They come and they look at the chart and they see gold going to 1650, 1640. And I kid you not, Jill, 90% of the people, because people are human beings, they get excited. They see the chart. Oh, this is going to 1550. Oh, this is going to 1550. Oh, I'm going to show you the Renko chart. Oh, I'm going to show you the Elliott wave count. Oh, and I said, tell me why. Convince me. Mm-hmm. And I said, okay. And for me, I was long gold. And I was like this. And I was like this. And everybody who came and told me that, you know, gold is going to 1550, I would feel bad. Then I would say, if it's somebody that I respect, I would say, okay, prove it to me. And I said, okay. And I'll tell you my idea. In this business, no matter how much experience, you have to doubt yourself and you have to be modest. And you have to be down to earth. Yes, you can have a loud voice. You can speak loud. You can have different personalities. But, overconfidence, be careful. And so basically, when I was looking at that, I told them, okay, I agree. Okay, I don't agree. You said it's going to 1550, but look at silver. And the listeners right now, they can look at the chart. Silver reached a bottom a few weeks before, or 3 weeks before gold. And platinum did the same thing. This is back in autumn 2022, okay? This time around, when gold went to 1810, okay, silver has fallen, but did not really break a kilo, neither copper, and that was a cheat sheet. That was intermarket analysis.
So what do you, I understand what you're doing. You're comparing. So what you said actually before is that most people, they look at the price. So they look at the previous low, previous high. I think human being, all what we are doing, we are anchoring and comparing the price to what we know from before. But what you do is you compare it to other things. And then you found in this example, you found a divergence. You see that all the others already go up. It's like an MACD divergence. And this is how you came to the idea to go long in gold.
Yeah, this is one of the ideas. And again, but this is very important, and I'm glad you said something at the beginning of this interview. You said something in this interview that, but correlations break. And I'm glad we're doing this live, because there is something very, very important about the last day of the month, yesterday, and the first day of the month, today. And usually when we are in the last day of the month, especially the last day of the quarter, we're not in the last day of the quarter. We're not in the first day of the quarter. But usually these correlations, they kind of break. But so that's a small detail. So what I said, I look at the other thing to see. And then some people said, well, Ashraf, what if the correlation is broken? You're looking at the wrong thing. You're having the wrong premise. And then I would say, yes, you're right. So I will have to check it. And there is something very important about this job. Whether you follow the Fibonacci retracement, whether you follow the 50 and the 200-day moving average, whether you follow your trend lines, whether you follow your Bollinger Band, when there is a break, one break is not enough. There is something called the false break. Lying is part of this world. The market lies. The market, of course, there's billions of algos going there to test it. But going back to the intermarket, I will try to summarize intermarket analysis in a recurring statement I heard from experts or from hedge fund traders or risk managers, and this is a recurring premise. Mm-hmm. What is it? I tell them, oh my God, the S&P, it broke below the 200-day moving average. That is very, very risky, isn't it? It's the end. And he says, well, Ashraf, I did not have to wait until it broke below 200. There is the pharmaceutical sector. There is this sector. There is this sector that had a double top and it broke long ago. Mm-hmm. So he's looking at something else. So or somebody else would tell you, I'll try. The reason I'm looking I'm trying to find another good example. So for instance, let's say you take the Dow and you take the Nasdaq and you take the S&P. Or let's say for those of you who are close to Europe, you take the DAX, and everybody's looking at the DAX.
Absolutely.
and then I'll tell you, wait a minute. The DAX had a triple top. A month ago, there was a triple or a quadruple top. A triple top in the Euro stocks. In the Euro stocks, it was a triple top. And every book of technical analysis tells you a triple top is bullish. It was not. It was bearish. But people who were trading the DAX, they were saying, it broke below. And I told them, no, wait a minute. There was a good signal from the triple top in the Euro stocks. Euro stocks. It's not just German. It is Eurozone. Euro stocks 50. Mm-hmm. And that is an important thing. So yes, you're trading A. Yes, you're analyzing A. Yes, you're looking at A. But you need to look at B and C and D, given they have a good relationship. And which one is trying to get your attention? You go to a party, Jill. Do you remember, Jill, when you were single and you used to go to parties and these women used to go to you and they used to get your attention? Okay, everybody's trying to get your attention in a different way. And
absolutely.
Who do you know? Who do you speak to? There is a way of getting attention. I cannot ignore this. Let me see. Is it worth it? I cannot. Is this a trap? That's what the markets do.
So I want to point something out, because this is also what I'm saying all the time. What I understand also from you, and I can't agree more than that, is technical analysis is good, but I must say, as long as I study technical analysis, as more subjective it gets. You can, like euro dollar, you can see the move from yesterday, you can see there's a correction, or you can see there's a trend reversal. And you need something additional that confirms your bias. Otherwise, you can't trade. Otherwise, you will, every time the market will trick you all the time. So you need something that gives you a strong bias in order to know what you have to do. Yes. Is that right, what I'm saying here?
Absolutely. Have you heard of Stanley Druckenmiller?
Of course.
So for those of you who don't know who Stanley Druckenmiller, he was the right arm man. He was the executioner of George Soros. Actually, he was the one who told George Soros about what to do with the Bank of England when George Soros broke the Bank of England in 1992. Okay? And Stanley Druckenmiller is one of the most successful, hedge fund traders and asset managers. And up to this day, he still speaks. And he said something very important. He's American, so he used the analogy of baseball. And he said, guys, if there is no fat pitch, if there is no situation where the confidence is so high, where the clarity is so high and is ideal, do not get in. Mm-hmm. And what you brought up, Jill, is the following. You said, Ashraf, the more I look at the same chart, the more I look at it, I don't get a clarity and it becomes subjective. And then me, Jill Paz, I will go to the 4-hour chart. And then I will go to the daily chart. And then I'll go to the weekly chart. And if it does not go out and grab you, it does not send you a message, forget it. Do not force the trade. It's nowhere near a fat pitch. If there is no ideal arrangement, do not take the trade. But let's say sometimes you have no choice because you have a loss. You are about to be margin called and the market is falling. And you say, should I get out? It broke the first support? Is there another support? Should I get out? And then you say, oh my God, I hope I'm not committing the big mistake of I will get out, and just when I get out, the market will go up. Am I committing this mistake? So I will look at something else. So if you look at the euro dollar right now, as we speak, you look at it. So it has fallen. It is 105.44. It's fallen below so it's fallen below the 55 DMA, which I use. But there is a trend line support from the October 3rd low. And that trend line support is around 105.40. But guess what? The right shoulder is not until where? 105. 105. Oh, but Ashraf, this is all nice technical analysis. But my $5,000 account on MT4 cannot tolerate 105. That is your business. That is not my business. Well, reduce the size, reduce the leverage, reduce this. Maybe open a short trade. Maybe open a short trade at 105.44 and target 105.10 or 105.10. Do a temporary hedge. Things like that. So you need to look at other things, but this only comes with practice. And guess what? This is why I created my website, ashraflaidi.com, in 2008, because it was a way for me to do an update or an application for my intermarket analysis. Okay. And I started writing articles for free, but it was an intermarket analysis. The book was written in 2007, but I never updated the book because it was a hassle. Because I did all the charts, I did them by hand with Excel.
Wow.
I did not have the Bloomberg that I have right now. Or I didn't have where you go to Bloomberg and then you get the data. I had to go to Yahoo, get the data. I had to get to the Treasury Department. I had to go to the Bank of Japan, get the dollar yen, and then get the interest rate. And then I had to go to Excel and to reconcile the different dates. All of that. But it's up to you whether you want to work hard or not. I was in New York. I was single. I was spending hours and hours at work at night trying to work it. Nobody told me to do it. My boss did not tell me you have to do it. My boss told me your job was to write, send stuff to client, and go on TV. That's it.
Yeah.
So it depends how much you want it.
So it became a passion.
It is a passion. It was a challenge. Yeah, it was ever since I got out of school and I looked at that at the markets. It was it was for me. It was a challenge. It's a challenge to look at the market, to work, to understand the market. But discovering technical analysis was a whole different thing, and it still remains a great teacher, technical analysis.
So Ashraf, I would like to talk about one product, and then I would like to talk about the Fed meeting. The one product, because I want to talk about gold, because gold is the product that I think in every single live session somebody asks a question about gold. Gold is the product. Now, about gold, there is a lot of myths. There is a lot of beliefs about gold. Gold is dropping. Gold is safe haven. Gold is going up when the market is dropping. Is it true? Gold is all kind of things. There is beliefs about gold, but what I experience, and maybe you can help me also here, gold often changes its story. Like I give you an example, what I believe. So gold gapped up a month ago because of a surprising war that broke out over the weekend. So we had a gap up, but then there was a lot of dynamics in. Now, by the way, I made a huge mistake. It gapped up, and I said, guys, this is a short in gold. Why? Because the bonds, the bond yields will go up, but that's bad for gold. Gold should go down. But there was a so strong dynamic, and I was wrong. So I think, again, that the story of gold is changing from time to time. Maybe you can talk a little bit about that.
Yeah. All right, that's very, very important. And maybe you should have started this session with gold, because when you start a session with Ashraf, when did you start doing this? People would, I'm not interested about his life. Tell me where's the market. So you should have brought this. But thank you and congratulations for all the listeners who are still listening and who made it up to this point. Okay, very good questions. I'm going to try to hit them one by one. First of all, I was long-term long gold, and I remain long-term gold with low margin, but the high leverage trades, I was short, and I had to close some of them, and I'll tell you why I was short. But yeah, I will go into that later. Okay, here's the thing about gold. If I try to summarize, if I think gold is going to 2,200, 2,300, probably within less than a year. I'm not going to talk about the fundamental, about the issuing debt, about all of that, which are all valid. I'm not going to talk about that interest rates that the authorities in the United States, they will have to keep inflation slightly higher to do something called reflating the deficit. Okay, There's all these things are important. No, I'm not going to go talk about that. I'm going to talk about this. There's a very important chart, and people can follow me at Twitter at Laidi, and I can put on those charts, or I can send them. There is a very important chart from 1973, which is like there are three or four cup and handles, and it goes like this, and like that, and like that. And the next target is around 2,200 and 300. Cup and handle, ladies and gentlemen, is another very important. It's like the cousin of inverted head and shoulder. It's the cousin, not the sister, not the mother, not the father. It's the cousin. Now, going back to gold, fundamental. Gold definitely will go down, will be under pressure not only when there is a rise in interest rates or when there's a rise in bond yields, but sometimes bond yields are up and gold is still up. Why is that? What is important is about inflation. And what is that? Here is what I'm going to say. So a few weeks ago, bond yields were pushing higher, but gold was going up. Not just because of the war, but actually, if it's because of the war, bond yields will have to go down.
Yeah.
People are buying bonds. But here is the thing. There is a very important... Okay, so before I speak about something which is very important, which we may revisit after the Fed, it's called the Bear Steepener. The Bear Steepener. I'm going to leave this aside here, and I'm going to revisit it because it's important. But gold usually... it rallies when the Fed says, when the Fed sends expectations that they're not going to be raising interest rates anymore, or when, obviously when there is a broad decline in the US dollar against everything, the dollar pushes, gold pushes higher. In parentheses, I would like to say the inverse relation between silver and the dollar is deeper, stronger than the inverse relationship between gold and the dollar. I will say this again. The inverse relation so that means that silver goes up and the dollar goes down, or silver goes down and the dollar goes up in a very strong way, much more than gold goes up and dollar goes down and vice versa. So that's important. But I think that now I'm going to talk about something called the bear. So I'm going to talk about something called the bear steepening. What is the bear steepening? If Powell sends the following message to the market, which is, okay, we're not going to be raising rates anymore, but the bond market vigilantes, they think that inflation will still be going to go back up, whether it's because of rising oil or because of... If they think that Powell not raising rates further going to push inflation back higher, you would think that yields will have to go down because the Fed is not going to raise interest rates anymore. But no, but if the bond market vigilantes, they think, if they're going to go back to sleep and not raise rates any further, then inflation is going to go up. So what will the bond market do? They will drive up bond yields on the long term.
Yeah.
not on the short term. So when you have something, and I'm not going to try to explain it because it's very complicated right now, but I will be more than happy to do a video about it or whatever. But it's called, so the yield curve steepens, and it's a bear steepening. That means that both long-term and short-term yields go up, but long-term yields go up farther, and that is very bad for the market. But that may not be bad for gold, because as long as the Fed is asleep at the wheel, he's going to let inflation go up a little bit. And gold, the ideal scenario for gold is a little bit of inflation, or maybe a lot of inflation, as long as interest rates are not way above the inflation.
I understand.
So that's one thing. And sorry, just one thing I want to mention this, and then maybe it will get people's attention, which is, if you look at the yield curve, so you all know that the yield curve inverts whenever there is a full inversion in the yield curve, meaning short-term interest rates go above long-term, or long-term go below interest rates. In the last 5 or 6 recessions, or 4 or 5 recessions, there was always a yield curve inversion around 6 months to a year and a half before that. Now, but what is there is that the Fed usually started to cut interest rates when the yield curve went back to normal, meaning it went back to steepening. But how does it go in steepening? It goes back into steepening in a way other than what it is doing right now. It's called the bull steepener. Right now, it's called the bear steepener. This is the first time that we have a bear steepener, and this is dangerous. And this is why, with another deadline of lockdown, of U.S. lockdown coming up, today, the other big news is the quarterly refunding of the U.S. Treasury, which is how much money they have to borrow to finance the debt. That is good for gold, that is good for Bitcoin. Technically, on a shorter level, I think gold could fall. It could, look, gold from 1810 to 2010, that's $200, okay? If you look at a chart, at a daily chart of gold, going back in the last year and a half, each time gold went up from low to high, to $180 or $200, that is an equivalent of 10%. Each time it went to 10%, it corrected around $60 to $70. That means there's a very good chance right now, where we are speaking, 1984, gold could go towards 1940. It could go to 1940. And guess what? The 200-day moving average of gold is at 1937. So gold could go back down towards the 200-day, stabilize, and then go back up. A fundamental guy could tell me... Go ahead.
Yeah, you do the beautiful thing. You combine technical analysis with your intermarket analysis, and I think this is absolutely amazing. By the way, with every sentence you say, I get new ideas to ask. Maybe just one more before we go to the Fed. And again, we have to talk about the Fed because everybody talks about the Fed today. But you mentioned just Bitcoin. Do you see a change in the behavior of Bitcoin in the last year?
Yeah, listen, Bitcoin, I'm sure you agree with me, but one of the most classical technical analysis adapted markets is Bitcoin. Bitcoin has showed us some very, very powerful signals. Where do I start? Oh my God. If you look at Bitcoin, there is a classic inverted head and shoulder on the daily, okay, where the head was around November of last year. The right shoulder was around June of last year. Sorry, the left shoulder. And then starting from March of this year, the low of March of this year was lower than the low of June of this year. So you have September low, June low, and March low. Each of the low is higher than the previous low. This is textbook technical analysis of higher lows. Then you have a neckline, and then you have a target. The target was at 35,000. So we hit 35, and now we are meandering around 34. So what's next? Now, what's next is that if you look at the weekly chart, there's something very important. And I was at an expo, a London Traders Expo in London on October the 21st, Saturday. And I was sitting at a panel of technical analysis, and I said, Bitcoin did something very, very, very important. This was 2 weeks ago. The week that it broke above the 55 and the 200, it also broke the week on the 100 and 200 day moving up. Okay, actually, let me get this right. Okay, so on the week, 2 weeks ago, Bitcoin went above the 200 week and the 100 week moving average in the same week. It broke above them.
Wow.
And that is on the weekly chart. And if you go on the daily chart, it was also on that same week, because the week has 5 days. On that same week, what happened? Gold, it was October 16th. Gold went, are you ready for this, Jill? Gold went above the 21-day, the 100-day, and the 200-day all in one day. So you have this confluence, and there's an important word. Anybody that likes technical analysis, it's called confluence. There is an important confluence, breakout confluence in the moving average on the daily, on the weekly. And if you don't like moving averages because you think that's voodoo or whatever, as you like this classical trend line, then I'm going to end something that sounds mysterious, that sounds sexy, that sounds God knows what, but I'll tell it to you anyway. My last YouTube video that I put on my YouTube channel, I put a video on a hypothesis that I tested since July when I was in Madrid in the crypto summit. And guess what, Jill? Whenever Bitcoin goes above $16 per ounce per gold, whenever the Bitcoin to gold ratio goes above 16 and it stays above 16, you're going up.
Oh, wow.
So there is an important, but this is not only on the upside of the downside. So please listen carefully before everybody stops listening and they go to the YouTube. And don't go to YouTube now. You subscribe.
They go to the MetaTrader, not to the YouTube.
Sorry?
They will go to the MetaTrader, not to the YouTube.
No, because in the YouTube video, it will show you what happened. So the first time that gold went above 16 ounce, the ratio was in 2020. And when it went up, it broke. But here is the thing. It also acts as a key support. So the first time when Bitcoin went to, I believe, 60,000, and then it went to 30. The first time it went to 60, it went to 30. When it went to 30, it stopped at 16. The ratio went around 20, but it stopped at 16. It stopped at 16, and then it went up. And then it went back up. So you look at the ratio. Listen to me. In July, when Bitcoin was going up, so all of you were trading Bitcoin back in July because everybody and their mother, they thought that Bitcoin was going to go above 33, right? It was July. That was the high. The high in July was 31,800, right? We were $3,000 below the target of the head and shoulder. Everybody thought we were going to break to 35. I thought we were going to go to 35. But guess what? Bitcoin, it went to 15.9, 16, and then it failed against gold. Now it broke. Now the ratio, Jill, pause. The ratio is around 17.9, around 18. So use this as a cheat sheet. But, there is the halving coming in April. We all know there is a very good correlation, which is usually November is a very good month. And my prediction, because everybody likes predictions, I'm going to try to give a gift to people, but of course, take it with a grain of salt. This is a risk. This is not a recommendation, and so on and so forth. But basically, I think that we're still going to have a difficult period in stocks, in indices, and I think Bitcoin will push higher, and maybe indices will start to push higher, I believe, at the end of next week. At the end of next week, meaning around November 6th or November 7th. And I think Bitcoin, November, it's probably going to stay above 35. If it stays above 35, I think it's going to go towards the 45,000. When do I think it's going to hit 60 or 65? I probably think it's going to go 55 or 58 or 57, probably around March or April. And just one last thing about Bitcoin. My last purchase of Bitcoin was at 40,000. I'm still at a loss. What did I do this year when Bitcoin started to go up in January, February? I bought Bitcoin. I bought stocks of Bitcoin miners.
Mm-hmm.
Stocks of Bitcoin miners. You buy it cash. They were $2. They went to $7. They were at $3. They went to $11. You use cash, one-on-one, not margin. You can have your Bitcoin at your wallet or at your Coinbase or at your a Trezor or at your Binance. Stay at 45,000 purchase. You can stay there. Don't touch it. But what you can do, you can look at these. And if you want these names, it's on my Twitter. Okay, so we can go to
so now we have to talk about the Fed, and we just have like 2-3 minutes left. But what I believe is what we are seeing is a policy change in general. We saw this: the ECB didn't raise the interest rate. Bank of Canada didn't raise the interest rate. The only central bank that start to be a little bit more hawkish is Bank of Japan. At the Fed, I think this is we don't have to be a hero to say that they will probably not raise interest rate. And what does it mean in Intermarket? What will be the changes that we're going from raising interest rate to be stable?
Yeah. Okay. I have to be very, very careful how to answer this. Why? Because it's really, listen, 5 years ago, if you asked me the same question, I would have said, oh, that's it. This is the end of rate hikes. Things are going to be very bad for the dollar. Mm-hmm. Because everybody's going to stop. And then they're going to start cutting. This is a naive Ashraf Laidi from 5 years ago would have said this. But but we need to look at other things because do you remember of November of last year? What happened in November last year? The Fed started to reduce the amount of rate hike from 75 to 50. Mm-hmm. When they went from 75 to 50, the dollar crashed as if there was a rate cut.
Yeah.
But there were other things in play, and that's Intermarket. There were other things in play. What were the other things in play? It was the Bank of Japan intervention on October 21st. Mm-hmm. It was AI and NVIDIA going up. There was a lot of money. This is the money flow theory. A lot of money discovering AI. Do you remember how AI? Yeah. It just went like this in November. The stock market went up. NASDAQ went up. Risk on came in. And people said, who cares about the Fed? That's it. They were doing 75, 75, 75. Now they're doing 50. This is great. And they started to, and then gold took off and everything took off. Is the same thing going to happen now? Because this is not the first time where they paused. They paused at the September meeting. Yeah, true. So, but here is the thing. Powell this time is going, so how do you trade the FOMC meeting? So we have a broadcast group. And again, I don't want to make this publicity and everything. I'm not going to say the link or whatever, but I'll tell you, what do? We have a WhatsApp group. And what do? 5 minutes before the Fed, I leave a voice note and I said, okay, we have to watch out for this. Whenever the Federal Reserve issues the announcement, I tell them like 10 seconds later, I send a voice note because I don't have time to do the writing. It's a WhatsApp broadcast group. It's it's like people cannot see each other. They can't talk to each other. And I tell them, okay, the change in the language was slightly was no big, but if there is no dot plot, because the dot plot comes every quarter, there is no dot plot in this time. But what we have to do, I'll tell them to ignore the volatility because there is the Powell speech, and his speech is going to come half hour later. Okay. Yeah. And by the way, for those of you who are in London or who are in Europe, because you've changed the time, it is 1 hour earlier right now, okay? So it is 7 p.m. Central European Time, the Federal Reserve, and it is 6 p.m. GMT/London, okay? But what's important is that I think the important thing, ladies and gentlemen, if you're a scalper, if you're a day trader, yes, there's a lot of opportunities in the 2 minutes after the Fed decision, and you can put a long and a short, and it's gonna revert. The real deal is going to start when he speaks. And what he's going to tell us, he's going to want to send the following message. Listen, people, we have left interest rates unchanged once again, but this does not mean we're going to cut rates. All right? Yeah. It does not mean we're going to cut rates. We have to keep rates high. Okay? So, guys, what is important is how harsh Powell is going to be by saying, yes, inflation is falling, but it is nowhere near defeated. And he's going to say something. If we have to raise rates again, we will have to. He will say it. Yeah. He will say it. And there will be a moment where it's going to upset the markets, because the last thing he's going to want to do is leave markets thinking that, okay, that's it. We're done with raising rates and we are going to be cutting rates. No, he's not. He's going to say the economy is very strong. We have done our job. We have put the brake on the car, but the car is not stalling. And I think there is going to be a moment today or tomorrow when I think we may have another hit in the NASDAQ and the S&P. And look at the 350-day moving average in the S&P. We may go to 4,080 before we push higher. The NASDAQ, I'm afraid we may go back towards 13,800, 13,700. Okay? This is the NASDAQ. Gold, we may go to 1940, 1937. So be careful. But Bitcoin, I hope Bitcoin will fall towards 31, towards 29, so I can buy more. But if it doesn't, I'm okay.
Ashraf, it was an absolute pleasure. Thank you so much. You gave us so much insights, and not only insights in general how to analyze, but the real tips. What can I tell you? Thank you so much. I'm sure the viewers got a lot here, and I hope in the future we will talk again.
Thank you. Thank you, Jill, and thank you, XM, for setting up this opportunity, for continuing to focus so much on these sessions for the traders. It's very, very important. I'm doing the Arabic part, which is very helpful to your clients.
Yeah.
And thank you guys for doing it in all the languages that you can do. So best of luck and happy trading, guys, today.
Thank you so much, and see you soon again.
Have a good one.